Hello everyone and welcome to Accounting Taxes SOS, where we cover everything accounting and taxes. This is my second video. For those who didn't watch the first video, go check it out. It's a little bit of an introduction about myself and why I'm doing this channel. Just to show you guys a little bit about what intermediate accounting was like. I did a couple of these activity and profitability ratios in that video. We just covered inventory turnover ratio, and then we covered the average days in inventory. If you guys want to check those out, they're in the last video, but we'll also be recovering those in this one, along with 8 other ratios. To make things short and sweet, we're going to go ahead and get started. I'm going to draw out the 2018 income statement and the corresponding comparative balance sheet for 2018 and 2017. For some of you, these numbers will look familiar. That's because I'm using the exact same income statement and balance sheet as I did in my previous video. The only difference is that we are going to be using the liabilities and shareholders equity section because we have a couple ratios like the return on shareholders equity and the equity multiplier ratios. Those two ratios, we will need the liabilities and shareholders equity accounts. So first I'm going to switch colors a little bit, so it might be a little easier to distinguish kind of the problems I'm doing here. So yesterday I did the inventory turnover ratio, but we'll go ahead and do that again for people who did not see yesterday's video. Okay. So I'm going to sum this down to inventory turn, or INV turn, just because the limited space I have. It's just a little bit easier and a little bit quicker. But this is just the cost of goods sold. You take this, the first step. Sorry, not 3,000. 6,350. And then you're going to divide you will take your inventory, because this is the inventory turnover. You can take your inventory, and then you're going to take your 2018 inventory, and then you're going to divide your previous year's inventory. Then you're going to close that, close the parentheses, divide by 2, and then these should be brackets here. Okay. Your final product should be 8.82. Okay, so what is this number? This number is the amount of times during the year that your inventory is turned over or sold. This is very important because we'll be able to figure out our average days in inventory with this number. So next we are going to do average days in inventory. VG. And I'm going to abbreviate again because save a little time and save a little space. We're going to start with 365, representing the number of days. And we're going to divide using our product from the inventory turnover, which is 8.82. Then we will get an answer of 41.39. This is the total number of days on average that our inventory, that our stuff is in inventory. So this is a very crucial number because you want to know how long you're holding inventory because holding inventory is expensive. Like I said in the last video, it just increases your expenses. It ties up your money. Ultimately, you're able to put less money to work for your company. So that is the importance of the average days in inventory. Next, we're going to do the accounts receivable turnover, the receivables turnover, REC. I'm going to abbreviate this time again. Receive turnover ratio. Okay. First, you're going to take your sales. It's kind of like the first one. 9,200. Use your division. And you go over to the accounts receivable. Use your $620 in 2018. And then, like last time, you go over to 2017, your previous year, receivables. $420. And then you take that, like last time, divided by 2. And you'll get a product of 17.69. Okay. And like the last time, this next computation will involve the product of your receivables turnover. So if we go to average collection period, we will take 365, representing the number of days, and then we are going to divide 17.69 to get a product of 20.63. And this just says that on average, you tend to collect money from merchants or whoever you're doing business with, and this represents number of days. So on average, you will receive your money within 20.63 days, which on average is pretty good. All right, let's move on to asset turnover ratio. For this one, what you're going to need is your sales, 9,200, divided by your total assets here, 4,260, compared to last year's 3,860. Then we're going to divide that by 2. And you'll get a product of 2.27. Okay. Now we'll do our profit margin on sales ratio. And I'm just going to write PM for profit margin. sales ratio. What you'll need for this one is, I forgot to leave it in there, forgot to add it in, so I'm going to go ahead and do that now. Is your net income of $348. There we go. 348 is your net income, and you will use that down here below, 348, and you'll compare that to sales of 9,200 to get a product of 0.037. Okay. And this one is a percentage. That's what it's most viewed in, is a percentage. So you're going to want to move that 2 decimal places to the right, which will give you 3.78%. There. Okay. We'll move on to the return on assets. I'm going to move this over here real quick because I think I'm going to run out of room very soon. Return on asset ratio. And I abbreviated just a little bit. Okay, so return on asset ratio, you're going to use your net income again of $348. And you're going to divide that with your total assets of 4,260. Compared to last year's 3,860. Divided by 2. And you'll get a product of 8.57. You guys cannot see that. Let me go back. I want to go over here, just right below. And this one is a percentage. You'll notice when you do the computation that it'll be to the right of the decimal. So you have to move that decimal to make it a percentage. In return on asset, I'm just going to read this one straight from the definition. It's a financial ratio that shows the percentage of profit a company earns in relation to its overall resources. So net income, the profit, and then over here, the overall resources, right here. Okay guys, we'll move on to the equity multiplier. The equity multiplier, EQ MULT multiplier, save a little space. The equity multiplier, you are going to need these two values, the 4,260, and you're going to compare that to 3,860 from year 2017. Then you're going to divide by 2. And that is the first step of the equation. There's 2 parts. Here you're gonna divide. And the second part, you're gonna take these two, the paid in capital and your retained earnings. And I can explain this to you guys in just a minute, what these two things are. So you're going to take the sum of these, that's 1,540. And then you're going to add these together, 1,390. 390. Hopefully you guys can read that. Sorry about my penmanship. And then you're going to divide by 2. You should arrive at a number of 2.77. Okay. So to sum up, 2.77, that is the percentage of the assets that are financed by the shareholders. To give you guys a little bit of a better understanding of what that is. All right, this is all I'm going to do for today. We covered quite a bit of ratios. I think this is probably going to be a pretty long video. So if you guys get halfway through it and you want to watch the rest of it later, you can pause it, add to your watch later list, and then watch that at your convenience. But guys, thanks for watching. Make sure you let me know if you like this video. If you don't like it, tell me why. We can make some changes. Keep in mind also that if you have any topic ideas, shoot me a message and I'll get to that as soon as possible. Otherwise, thank you guys so much for watching, and I'll catch you in my next video.